Uh, this indeed is a timely refresher and update given the recent tax cuts at the end of December of 2017. But I'll just put you on notice, this is not a tax accounting this is not a tax class per se, it's a tax accounting class, which is very good. It's accounting for income taxes, which is an area that most accountants are very weak at. So let's give a little history, and we'll give some good examples, and I think by the time we finish, you all will feel pretty good about accounting for income taxes. All right, if you go right to your slide, it's, I guess it's slide number 4. I got up on the board there. A little history here. We had a problem many, many years ago, and the problem was created by the accounting literature, by APB opinion number 11, which is accounting for income taxes. And that particular pronouncement was income statement oriented. It required that the income tax expense, or the provision for income tax, had to be directly related to the reported net income. In other words, you figure out your reported net income on the GAAP financial statements, and then if you had a 50% tax rate, 50% of that reported net income was the income tax expense. Okay? And that was the way it worked, and that was an income statement approach to it. So under that APB 11, the expense was always equal to the corporate effective tax rate times the reported net income. And that supposedly gave a proper matching, of course, with revenues. And it honored the famous 1960s matching concept principle that we had in generally accepted accounting principles. I'll give you a little baby example here. In 1960, the corporate rate was 50%, 50, and we all lived pretty well with that. Now we got it down to 21%, and we got deficits, and we're broke. Anyway, if the corporate reported net income was $1 million, the GAAP net income, we made a journal entry that looked like the one you see up on your screen there. Debit, income tax expense, 50% of the million or 500,000, and credit income taxes payable for 500,000. So again, the tax expense was directly related to the reported net income. But then the life changed. In the 70s and the 80s, we started manipulating the tax code in this country, okay? And the regulations changed, all right? And most of the changes in the Internal Revenue Code and the regs really were to promote social events and economic activities. We started using the code as a tool to get certain things done. For example, rewards were given to corporations that acquired certain types of assets. So if you bought a certain type of asset, you were allowed to speed up the depreciation, or you were allowed to take the so-called investment tax credit. All right, so these were good benefits to corporate America that were built into the code. Now, in the 60s, we didn't have that. In the 70s, we did. Now, these extra rewards or benefits would really change the scenario. It would make taxable income for the first time different than reported net income, which creates a problem for accounting for income taxes, okay? So if you move to the very next slide, the depreciation incentives in particular were the most beneficial to corporate America. Remember, we were primarily a manufacturing-based economic society back then. We're not now. Now we're consumer-oriented. It's entirely different. So the speed-up or acceleration of the depreciation created depreciation expense on the tax return that was much higher than the depreciation expense on the GAAP financial statements. So that resulted in taxable income that was lower than the reported net income. Hence our first big problem here. All right, so if you move to the, move to the next slide, the difference between the taxable income and the book income was the extra depreciation allowed in the early years of the life of a newly acquired asset. So because the depreciation tax benefit given to corporate America, the tax expense and the related tax payable based on the reported net income, which was the old matching concept, was lower than the taxable income and the current tax liability. Let's look at this hypothetical example here on your slide number 10. Assume a company has net income, reported net income on the books of $1 million, and we have a 50% tax rate. Further assume they go out and they buy $500,000 fixed assets with a $50,000 salvage value, and it's going to be depreciated over estimated useful life of 5 years. Okay? Under the straight line method, which they're going to use for the books, the depreciation will look like this next slide. And there it is. It would be $90,000 a year. And after the 5 years, the carrying value of the fixed asset would be $50,000, which is the salvage value. So the book should be $90,000 a year. However, for the first time, because of the changes to the code, you were able to use double declining balance on the tax return, which is modified accelerated cost recovery system. Okay, and that would of course give you a different depreciation. This is a 5-year asset, so instead of depreciation 1/5 or 20% a year, you would double that and take 40% a year. 40% of what? 40% of the declining balance. So you can see on the tax return, you take the $500,000 asset in the first year, you would depreciate $200,000, not the $90,000 that's being depreciated on the books. Okay, and then the balance, of course, book balance became $300,000. Second year, you took the $300,000 times 40% and depreciated $120,000. So the depreciation was not 90, 90, 90, 90, 90. It was 200, 120, 72, 43.2, and 14.8. You can see you're getting some big benefits in those early years, particularly the first 2 years, which was the whole idea. You want to stimulate the economy. That's why they use the code to put these benefits out there. Okay, so the 5th-year depreciation expense is limited to 14.8 because the book value should not be less than the salvage value. So if you looked at the books, we saw the left-hand side, depreciation of 90, 90, 90, 90, 90, but on the tax return we had 200, 120, 72, 43, 14.8. The differences between the book and the tax depreciation are in that next to last column that you're looking at. And if you tax affected those at the 50%, you wound up in the first year with a $55,000 credit, which for all practical purposes is an interest-free loan from Uncle Sam. All right, it's the government saying, take a little extra depreciation, reduce your taxable income, pay less tax. So we paid $55,000 less tax in the first year. And then the second year, we didn't pay it back. We took another $15,000 loan. And then eventually paid it back in years 3, 4, and 5. And that's the way it worked. Well, it's a heck of a lot different than the way it worked before. So in year 1, we had an interest-free loan, in my little example here, of about $55,000. That's exactly $55,000. In year 2, we got another interest-free loan for $15,000. And then theoretically, the loans were paid back in years 3, 4, and 5. So it all looked pretty nice and neat, but that was in theory. So to honor the matching concept, the journal entries over the 5 years, if we assume $1 million a year, reported net income, and the only difference between book and tax is that extra depreciation, then we'd wind up with taxable income of what you see, $890, $970, $1,018, $1,046.8, and $1,075. We're going to get the same numbers in the end, but they're just going to be in different years. So the journal entries each year would be a little bit different. The first year we'd have income tax expense of $500, but the taxes payable current would be 50% of $890 or $445. The difference would be deferred taxes payable, the $55,000, the interest-free loan. So deferred taxes payable is similar to an account called Due to Uncle Sam. Okay? All right, so the difference, not a plug, it's really the amount that we owe Uncle Sam that we're going to pay back in the future years. In year 2, we borrow another $15,000 because of the mechanisms, because of the benefits that are built in to the tax code. And then theoretically, in years 3, 4, and 5, you can see we start paying it back. So we debit the deferred taxes payable account in years 3, 4, and 5. Okay? So when the smoke clears, that account would theoretically zero out. It's great theory. The theory is great. It's logical. It seemed to make sense. The first 2 years of the interest-free loan was set up as a deferred taxes payable. The loan was paid off in the last 3 years. The borrowing and the eventual payment was great theory, but it didn't really work in reality. Okay? In practice, it didn't work. Why? Because the tax rates change sometimes over the years. More importantly, the asset might be sold. It might not be around for the 5 years. It might be sold, it might be retired after year 2, then we buy a new asset and start the game again. So it's very conceivable that many of these so-called deferred tax payables never really turned around. Plus back then, in the kind of economy we had, there was continuous growth, which created a liability that just got bigger and bigger and never declined. Plus corporate America was not very careful about this deferred tax account. They just threw things in. It was like the plug account, which debit expense where the taxes payable current, throw the difference in the deferred tax account. Okay, and they didn't really keep good records on it. And that's the corporate America and the auditors as well, all right? So what happened is the deferred taxes payable account got larger and larger and larger. It never really turned around. In other words, it never got paid back. Corporate America never paid back this interest-free loan. So in a number of cases for a growing company, the deferred taxes payable became greater than the stockholders' equity. I can remember myself, I had clients where we had deferred taxes payable, some huge number. Nobody knew what the heck was in it. We didn't have the support, but they lost control of it, and that number was greater than the total stockholders' equity. So we couldn't go on saying the biggest item on the right-hand side of the balance sheet we can't explain. So it was clear something had to be done. The income tax approach simply wasn't working. So the regulators had to throw away the matching concept. The matching concept had to be changed because it created a fake liability. All right, we had a liability that couldn't be explained, and it wasn't really a liability because it never got paid back. So the FASB abandoned the income statement approach, and they developed a balance sheet approach, which is what we have now. And that focused on creating the correct deferred tax liability or correct deferred tax asset without concern for matching the income tax expense with the recorded net income. All right. So if you look at the next slide, the balance sheet approach, it didn't take hold very easily. A lot of people fought it. As you know, most people don't like change. So there's always a fight when there's a significant change. When we switched from income statement approach to balance sheet approach, there was a lot of opposition. So in '87, they issued FASB 96, accounting for income taxes, that superseded the old APB opinion number 11, where the problem was created. And 96, of course, abandoned the income statement approach and substituted it with the balance sheet or asset liability approach, all right? So the balance sheet approach, included in 96, was not greeted with open arms. It proved to be very controversial. So even though in '87, the pronouncement was issued, it took a long time coming. It was deferred several times by FASB 100, 103, and 108. It just kept deferring the effective date because they couldn't get agreement. Finally, FASB 109 established the balance sheet or asset liability method for accounting for income taxes, and that was effective for fiscal years beginning on or after 12/16/92. So it took 6 years after the issuance of 96 to get to FASB 109 to finally embrace the balance sheet approach. All right, now, what did that approach do? Stay with me here. 109 introduced some fundamentals into the literature. Pre-tax financial income became a term that we use, and that was really synonymous with income before taxes, or income for financial reporting purposes, or income for book purposes, or just reported net income. That was a new term that was introduced by FASB 109. All right, and taxable income was the term that we introduced in 109, and that really is the tax accounting term used to indicate the amount by which the company's income tax payable is computed. So it would be the effective tax rate times the taxable income to come up with the tax liability. And that's got nothing to do with GAAP. That's determined by the Internal Revenue Code. And the GAAP regs are different in many ways than the company's pre-tax financial income. There was usually a difference. And the typical differences, of course, were, number one, we already talked about, the depreciation. Usually, depreciation was computed on a straight line basis for GAAP financial reporting purposes, but an accelerated method, modified accelerated cost recovery system, for the tax return. Or, another typical difference was income was recognized on the accrual basis for financial reporting, but it might have been recognized on an installment basis for tax purposes. So if you sold the building for the tax return, you had a big gain on it. For the taxes, you like to dribble it in on an installment basis over time. But you had to book the whole thing under the accrual basis under GAAP. So that was a significant difference between book and tax. Thirdly, unrealized holding gains and losses on investments in marketable securities, for example, available for sale securities. All right? They're immediately recognized on the books. You know, if it's a trading account, they go into the income statement, these unrealized holding gains and losses. If it's available for sale securities, they go into other comprehensive income when we mark to market. But that's not on a tax return. The tax return says don't give me anything about gains and losses until they're realized, until you sell the security. So we had these big differences between the unrealized holding gains and losses that are recorded and the unrealized holding gains and losses that don't appear anywhere on the tax return. Another significant difference between book and tax were warranty costs. They were recognized in the period incurred, when we make the sale on the books, but for financial reporting. But they're recognized when they're paid for tax purposes. For example, you bought an electronic product, a toaster or something like that, you got a guarantee or a warranty that if the toaster didn't work, you can bring it back and they give you a new toaster. Okay, so you had to set up estimated warranty costs on the GAAP financial statements based on your estimate of how many people are going to want to, bring back the toaster because it doesn't work, it's defective, and honor the warranty. But you couldn't deduct that warranty cost until the toaster was brought back and a new toaster was issued. So once again, we had a timing difference between warranty expense on the books and warranty expense on the tax return. And lastly, one familiar with us, multinational companies. Their operating income earned outside the U.S. is not taxable until it's repatriated. And then it's taxable only when it's brought back into the United States. So the income is recorded on the books for GAAP purposes when it's earned, but it's not taxable until it's repatriated, creating a significant deferred tax item in the year when it's earned. Excuse me. So you can see we have significant differences between book and tax. They're going to create these deferred tax issues, okay? Now, stay with me. If you look at the next slide, this is an example here. I think it's your slide 25. This is a company, the ABC State Bank, a de novo bank, which means it's a relatively new bank. And in the year 2017, which is its fourth year of operation, it had income from sales of OREO, other real estate owned. This is they foreclose on a loan. So the loan receivable turns into an asset called other real estate owned, and then they sell it. All right, so the bank gets his money back. All right, they don't want the asset. They take over your house. They don't want your house. They want to get their loan money back. So anyway, the income from the sales of OREO is $130,000 for the books, but only $100,000 for tax purposes, and they had expenses of $60,000 for both book and tax. So there's going to be a $30,000 difference between income on the books and the income on the tax return because of the sale of the OREO. Okay, because they use on the books the full accrual method, which is FASB 66, which is now Accounting Standards Codification 360-20. But on the tax return, we use cash basis, all right, for tax purposes. So what's going to happen is this. On the financial income, the books will show revenues of $130, less expenses of $60, for pre-tax income of $70,000. But on the tax return, we'd have $100, less $60, for $40,000 taxable income. So the taxes payable would be, assuming a 40% tax rate in this example, 40% times the $40,000 or $16,000. That would be the income taxes payable dash current. All right? So, that's step one. After we figure out the current income tax, we got to say, are there any other taxes to consider? Like what? Like deferred taxes. Okay, that we have to recognize currently that have a future impact. So the answer depends on whether there are any temporary differences between what's on the books and what's on the tax return. And in our little baby example, we do. We have that $30,000 difference that is a big difference in 2017, but it's going to turn around in future years. Okay? So, we call that a temporary difference. So a temporary difference is the difference between the tax basis of an asset or liability and its reported, in other words, the book basis, amount in the financial statements. That will result in taxable amounts or deductible amounts on the tax returns in future years. Taxable amounts would increase taxable income in future years, and deductible amounts would decrease taxable income in future years. So in the ABC situation, this de novo bank that we just looked at, the only difference between the book basis and the tax basis is the uncollected amounts from the sale of OREO, or that $30,000. All right? So, the following indicates that the receivable from the OREO sale are reported at $30,000 at year end on the GAAP financial statements. But on the tax return, there's no receivable. So the $30,000 difference is a temporary difference that was originated in 2017. What's going to happen to that difference, assuming they expect to collect $20,000 of the amount receivable in 2018 under the installment basis, and $10,000 in 2019. So that will result in future taxable amounts of $20,000 in 2018 and $10,000 in 2019. Everybody with me, I hope? The future taxable amounts will cause taxable income to exceed pre-tax financial income in both 2018 and 2019. All right? In other words, taxable income in 2017 will be less than book income, but then by $30,000. But then in the following 2 years, it'll be more by $30,000. It'll turn around. So the company, ABC, must recognize currently in the year 2017 the deferred tax consequences of these temporary differences. Okay? So, the amount of income taxes that would be payable or refundable when the reported amounts of the assets are recovered and the liabilities are settled must be recorded in the current year, in our case, in year 2017. So, here's what we're looking at for ABC. They're going to collect the receivable of and report $30,000 as follows. In 2017, we'll have the $30,000, but we're not going to collect it till $20,000 in 2018 and $10,000 in 2019. So on the tax return in 2017, on the tax return, we'll have zero in 2017, 20,000 taxable income in 2018, and 10,000 taxable income in 2019. The whole 30,000 is income on the books, the GAAP financials, in 2017. So we're going to have these differences between book and tax for 3 years. Okay? So how does that affect us? Well, let's go to the next slide. In 2017, the future consequences of these reversing differences between book and tax have to be accounted for as a deferred tax liability. In other words, the interest-free loan from the government has to be set up in 2017 and they get paid back in 2018 and 2019. So, for ABC Company, go to the next slide, the current income tax payable is easy. That was the $40,000 times 40%, or $16,000. In addition to that, in 2017, there's a temporary difference that exists at year-end because the income and related amounts receivable are different. The book basis of the receivables is 30, tax basis is 0. So, we have to worry not only about the current income taxes payable, we got to worry about the deferred taxes payable. So, assuming no changes to the enacted tax laws or tax rates, for the future, the total deferred liability at the end of 17 is $12,000. We already know $16,000 is the current taxes payable. Well, the $30,000 receivable, all right, we had none in the beginning, $30,000 at the end, so the cumulative temporary difference of change is $30,000 at 40% rate, assuming no changes, is $12,000. So we'll have a $16,000 current taxes payable and a $12,000 deferred taxes payable. So another way to compute that, if you're following me, to read the deferred tax liability is to prepare a schedule that indicates the future taxable amounts as a result of the existing temporary differences. Well, we only have one difference here. The next slide shows you the schedule, which of course would be more complex if there was more than one temporary difference. Okay? Here we only have the one. So in the current year, we have $30,000 at 40% gives us a deferred tax liability of $12,000. And that's a liability we're going to pay in 18 and 19. How are we going to pay it? $8,000 in 18 and $4,000 in 19. So, and we're assuming there's no deferred tax liability in the beginning. Again, it also assumes there's no change in the tax laws. So again, we'll have a $16,000 current expense and a $12,000 current payable, taxes payable, and a $12,000 deferred tax payable. If you look at the next slide, it will look like this. The income tax expense would be as follows. $12,000 deferred tax expense for 2017 and $16,000 current income tax expense for 2017 for a total of $28,000. All right, and that's how you do it under FASB 109. Now, what you would put on the income statement would be something that looks like that. If you needed a partial income statement, it would say, here's the income before taxes, $70,000, I'm just giving you that number. Then you'd say less the income tax expense, and you have to disclose the two pieces. The current portion is $16,000, the deferred portion is $12,000, for a total of $28,000 to reduce the net income down to $42,000, right? So both the current and the deferred portion have to be reported. Now, you could show it like that on the face of the income statement, or you could just show on the income statement $70,000 less $28,000, then somewhere in a footnote disclose that the $28,000 consists of $16,000 current taxes payable and $12,000 deferred taxes payable. All right? I hope you're getting the flavor here. Okay? Another option is to simply report, as I just said, the total tax on the income statement, and then in the notes to the financials indicate the current and deferred portions. Now, when we say income tax expense, we really call it the provision for income taxes. So using that terminology in our little example here, the current provision would be $16,000, and the provision for deferred income taxes would be $12,000 for a total provision of $28,000. So in the 109, always, the income tax expense has two components. The current tax expense, which is the amount of income tax payable currently for the period, and the deferred tax expense, or it might be deferred tax benefit. Okay? So deferred tax expenses really represents the change in the deferred tax liability from the beginning of the year to the end of the year. The taxes currently due and payable are credited to income tax payable, current, and the increase in deferred taxes is credited to deferred taxes. The sum of the two items is debited to income tax expense. So in our little baby example, the journal entry that would be made is what you see on your slide 43. We would debit income tax expense for $28,000, credit income taxes payable current for $16,000, and credit deferred tax liability for $12,000. And that would all be in compliance with the new balance sheet approach, FASB 109. All right, now, that talks about deferred tax liabilities. Now, let's just change the facts a little bit. Let's assume in 2017, in our example, they changed the tax rates from 40% to 20%, much like they did this year at the end in December of 2017. The tax rates went from, for corporations, effective rate of 39.6 down to 21%. So in my example, we said 40%. Let's assume they change it in December of 17 to 20%. So that deferred tax liability of $12,000 has to be remeasured. All right, it's in effect market to market, right? Once a tax change is enacted, or a tax rate is enacted, we have to remeasure the liabilities. Accounting Standards Codification number 740 requires a company to account for the impact of a change in the tax law or a tax rate in the period of the enactment. So in our case, it would be December of 17. This restatement would be recorded through net income, through continuing operations, even if the related deferred items being remeasured were originally established through recording into other comprehensive income, which creates a stranded item that we're going to talk about a little bit later, okay? So, in this example where we say assume the tax rate went from 40% down to 20%, we're going to have a windfall. So in effect, you'd have to make a journal entry that looks like what you see staring you in the face in your slide 45. Reduce the deferred tax liability from 12 down to 6. So I'd have to debit deferred tax liability for 6 and credit income tax expense for $6,000. And that's income tax expenses continuing operations. And that, of course, would remeasure. It would reduce the deferred tax liability, calculated at 40%, to the newly enacted rate of 20%. Everybody with me there? That's the windfall. That's what everybody saw this year, 12/31/17, when they cut the rates from 39.6 down to 21%, among other things. Okay? So the tax rate, in effect, in my little baby example here, created a windfall. It created $6,000 of new income. So, at the end of 2018, the difference between the book basis and the tax basis of the receivable is now $10,000, right? Remember, it was 20 and 10? Now it's going to be 10 and 5. Okay? So it's now 10,000. The difference is then multiplied by the new lower rate. So 10,000 times 20% would give you a liability of $2,000 to report it at the end of 2018. Okay, hope you follow me here in this example. Okay, so assuming the income tax payable for 2018 is $19,000, I'm giving you that. The income tax expense for 18 would be the deferred tax liability of $2,000. At the end of the period, it was 6 in the beginning, so it's a -4. It becomes a benefit. And the current tax expense of 19. So the total tax expense for 18 is $15,000, right? Which consists of $19,000 current tax payable and a reduction of the deferred tax liability of $4,000. Everybody with me there? So what would happen is you'd have to make a journal entry into 18 that looks like what you see up there. Debit income tax expense for $15,000. Debit the liability, deferred tax liability for $4,000, because it's turning around now. And credit income taxes payable for $19,000. If the entry to record income taxes at the end of 19, the following year, the deferred tax liability would be reduced to $2,000. If you had access to the books and records of this little baby company, the general ledger would look something like this. The deferred tax liability account was set up for $12,000. Then you reduced it by the remeasurement, put it down to $6,000 after they reduced the tax rates from 40% to 20%, and all of that happened in 2017. So you really set up a liability of $6,000 in 2017, and then it turned around 2018, 2019, and it, all other things being equal, it then zeroed out. All right, and have a zero balance at the end of 2019. Okay. And that's the whole story for deferred tax liability. That's going to turn itself around. Let's go to deferred tax asset. These are future deductible amounts. All right? Here's another example. Assume that during 17, DEF Bank, this is a different one now, they estimated its bad debt expense or provision for loan losses is going to be $50,000, which the bank believes will result in loan write-offs of $25,000 in each of the next 2 years. So the provision is like the bad debt expense. So they're going to have a provision for loan losses of $50,000 in 2017, but they're not. They're going to say debit provision for loan losses and credit allowance for loan losses, which would be a contra account that travels with the loans receivable to reduce the loans receivable to net realizable value. But they're not going to write off the loans until the next 2 years, 25 in each of the next 2 years. So we're going to have differences between book and tax. So the provision for tax purposes cannot be deducted until it's written off. Those are the rules of the IRS. That's not GAAP. That's like cash basis. Uncle Sam is saying, don't take it over the tax return till you write off the receivable. I don't care what you expense on the books. That's your business. But don't take it on the tax returns. Uncle Sam is like a cash basis man, so to speak. So the provision creates a future tax benefit that is reported in the 1217 balance sheet as a deferred tax asset. In other words, at the end of 17, Uncle Sam owes me the deduction for the $50,000 bad debt expense or provision for loan losses. So what does that mean? Well, let's take a hard look here. Here's what you're looking at in a DEF situation. In 2017, on the books, we got a $50,000 loss, provision for loan losses. But we're not going to write off the loans until 18 and 19. Okay, so that really is the basis for a deferred tax asset. All right. So a deferred tax asset is the deferred tax consequences attributed to deductible temporary differences. In other words, I got a $50,000 expense on the books in 17, but I'm not going to take them over in a tax return until half in 18 and half in 19. That's when they'll become a benefit for me on the tax return. All right. So the deferred tax asset represents the increase in taxes refundable or saved in future years as a result of deductible temporary differences existing at the end of the current year. Okay, so at the end of the current year, I got $50,000 of expenses on the tax return that Sam owes me. I can't take them on the 17 return, but it'll let me have them on the 18 and the 19 return. So when somebody owes you something, it's like an asset. So the deferred tax asset is like due from Uncle Sam. Hope you're getting the picture here. Okay? So the computation of the deferred tax asset at the end of 17 assuming that new rate of 20% replaced the 40%, would be the $50,000, all right, and we had nothing in the beginning of the period, times 20%, or $10,000, okay? Another way to look at this is to say the deferred tax asset, you prepare a little schedule that indicates the deductible amounts, and we only have one here, schedule for the future, and then grind it out by the tax rate. So we know in the future we're going to have $50,000 of deductions that will be allowed, times 20%, has a value of $10,000 due from Uncle Sam, deferred tax asset, $10,000, okay? All right, so stay with me. Assume that the current taxes payable for 17 is $100,000. That's a given. I'm giving you that one. And there are no prior temporary differences. So the tax expense would be 10,000 minus 0 gives you what? A negative 10,000, which is a benefit. And the current tax expense is 100. So the journal entry would be debit income tax expense for 90,000, credit taxes payable current for 100,000, and debit deferred tax asset for $10,000. Hope you're with me there. All right. So again, make a big distinction between the tax expense and the taxes payable dash current. The difference being an adjustment to a deferred tax account, whether it was the liability we saw earlier or the deferred tax asset that we see right now. Okay. So that's the deal on the deferred tax asset. So the deferred tax benefit results from the increase in the deferred tax asset from the beginning to the end of the accounting period. For the DEF company, the deferred tax benefit is a negative component. So the total income tax expense of $90,000 on the income statement consists of two elements: the current expense of $100 and the deferred tax benefit of $10,000. So it's 100 minus the 10 gives me the income tax expense of $90,000. Again, if you had access to the books and records, and you can get your grubby hands on a general ledger, it would look like that. In other words, in 217, you set up the receivable for tax asset for the $10,000, and then as you wrote the the loans off, $25,000 each year, you got a $5,000 benefit in 18 and a $5,000 benefit in 19, which is really the collection of that receivable. All right? So it makes a lot of sense for whether it's a liability or whether it's an asset. Now, if it's an asset, we got another wrinkle. Stay with me. A deferred tax asset is recognized for all the deductible temporary differences. So we could have provision for loan losses, holding losses on trading securities, holding losses on cash flow hedges. All of those things would be losses on the books that you cannot take on the tax return yet. You can take them later. That's why Sammy owes me the deduction. That's why it's a deferred tax asset. All right. However, the deferred tax asset that we set up has to be reduced by evaluation allowance if, based on all available evidence, it is more likely than not that some portion or all of the deferred tax asset will not be realized. So if you, like any asset, if you set up the asset and you say, well, I don't think I'm going to collect it all, then you'd have to set up some kind of contra account, some kind of an allowance, a valuation account. And by more likely than not, it means there's a likelihood that's a little bit more, slightly more, than 50%. Okay? So every time I wind up with deferred tax asset, I gotta say, do I need a valuation allowance? Okay? Now, let's look at an example. Assume GHI Corp has a deductible temporary difference of $1 million. Again, this could be the provision for loan losses at the end of the first year of operations. Tax rate, 40%. So they'd have a deferred tax asset of 40% times the million, or $40,000. Assuming the current income taxes are $900, and that's a given, I'm giving you that, you'd have to make a journal entry that says debit income tax, let's do it backwards. Credit income taxes payable for the $900, debit income tax expenses current for $500, and set up a deferred tax asset for $400,000. Okay? And that's the way you'd have to take a look at that. And then, of course, since you have an asset, you got to say, do I need a valuation account, an allowance? So after careful review of all the evidence, you have to determine, is it more likely than not that $100,000, well, what amount? Let's say you did this, and then you did determine that it was more likely than not that $100,000 of the deferred tax asset will not be realized. So you're not going to realize the whole $400, you're only going to realize $300. So therefore, the carrying value of that asset should be $300,000, not $400,000. So you have to make a journal entry that says debit more income tax expense for $100,000 and credit a valuation allowance. And you might call it allowance to reduce deferred tax asset to expected realizable value, $100,000. So in this particular journal entry, the income tax expense is increased in the current period because a favorable tax benefit is not expected to be realized for a portion of that deductible temporary difference. So a valuation allowance has to be simultaneously established to recognize the reduction in the carrying amount of the receivable, called deferred tax asset. So that valuation account or allowance is a contra account, and it may be reported in the balance sheet in the following manner. Let me show you what it would look like. So on the left-hand side of the balance sheet, you'd add your deferred tax asset of $400,000, and then you'd say less allowance to reduce deferred tax asset to expected realizable value, and you'd put the balance in the valuation allowance of $100,000 to reduce the asset to its net realizable value, which is $300,000, just like you would do with any other loan receivable or any other receivable. The deferred tax asset, think about it as a receivable from Uncle Sam, due from Uncle Sam. You're not going to collect the whole 400, you're only going to collect 300, so that's what the book should show. That's why you had to set up the valuation allowance, okay? So you got to do that every accounting period. So every time you present the balance sheet, which could be quarterly, you got to do that. So the allowance account has to be evaluated at the end of each accounting period. If at the end of the next period, the deferred tax asset is still 400, but now 350 of that 400 is expected to be realized. So you don't need a $100,000 valuation, you only need $50,000. So you'd have to, make another journal entry. This time you would debit the valuation allowance and credit income tax expense. Okay? You would debit allowance to reduce the deferred tax asset to expected realizable value, that's the valuation allowance, and credit income tax expense for $50,000. Okay? To get the deferred tax asset to its correct net realizable value. So, very important. All the available evidence, both positive and negative, should be carefully considered to determine whether, based on the weight of all the available evidence, a valuation allowance is needed. For example, maybe the company is experiencing a series of lost years. Well, if that's the case, a reasonable assumption, if there's no other facts, a reasonable assumption is that these losses will continue, unless you tell me something differently, and the benefit of the future deductible amounts will be lost. Let's look at a comprehensive example. Let me go to the next slide. Yeah, here's a comprehensive example. This is the famous XYZ company. Let's look at the facts for starters. They have nothing in the beginning, just to keep this example clean. No deferred tax assets, no deferred tax liabilities on January 1st of 17. And that's for illustrative purposes, right? In addition, for the past 3 years, they didn't pay any income tax because they availed themselves of net operating loss carry-forwards, which are now exhausted. Okay, now the carrybacks and carry-forward rules have changed under the new law. We'll talk about that in a minute. I'm going to talk about the old law first. So on January 1st, 2017, XYZ goes out and buy $100,000 of fixed assets. And they elect to expense $10,000 of that immediately under Section 179 of the IRS Code. The balance, they're going to depreciate using the straight line method, half-year convention, strangely for both book and tax. I don't know why. You would think they'd use straight line for books and accelerated for tax, but in this case, is a real life case, they did it for both book and tax purposes. Okay, so we're going to have a little temporary difference there because of the depreciation. Okay, they also expensed $60,000 for litigation settlement. Maybe it was patent infringement case, something like that. They were sued, they lost $60,000. So immediately under GAAP, they have to exercise the doctrine of conservatism, so they would say debit litigation cost $60,000, credit some kind of liability for $60,000. But the court said they have to pay it out evenly over the next 5 years. So that's going to create a deferred tax item because the $60,000 will go on the tax return 1/5, 1/5, 1/5, 1/5, 1/5. In other words, 20% for each of the next 5 years. But 100% of it goes on the books immediately in 2017. So there's another temporary difference. And then the loan loss provision of $15,000 was recorded on the books in 17, and no loans were written off, so there's no deduction on the tax return for loan losses. All right, those are the facts. I don't remember the facts. Now, let's go to work. For the depreciation, what's going to happen? Well, look at the chart that I'm looking at on your slide number 67. Here's the way the depreciation is going to work. Well, for a straight line, and I use remember the half-year convention, and it's a 5-year asset, and it costs $100,000. So straight line, you would have said on the books, you take $20,000 a year, right? But in the first year, you take half, and in the last year, you take half, and in the middle years, you take 20. So look at the books. So on the books, you'd say 10, 20, 20, 20, 20, and then 10 at the end. And that's what the GAAP financial statements would have for depreciation expense. However, on the tax return, you do the same thing, except you're going to take an extra $10,000, Section 179. So that means you got to take $9,000 plus the 10 in the first year, and $9,000 in the last year, and 18 in the middle years. So you're going to depreciate $100,000, the total cost of the fixed asset. That's what, it's going to be the same, but they're going to hit in different years. So you can see we're going to create a temporary difference in the first year, a $9,000, which is going to be the basis for a tax-free loan from Uncle Sam, which is going to be a deferred tax liability, okay? And then the $9,000 gets paid back 22221. Actually, it's the tax rate times these numbers, okay? All right, now assume we had pre-tax book loss of $26,000. Let's go to your next slide, if you don't mind. All right. So I start out with a loss of 26, and I got to arrive at taxable income. Okay? So the litigation settlement of $60,000 was an expense on the books that helped create that loss. I got to add that back because I can't take it on the tax return. So I add back the 60 to the minus 26. Same thing with the provision for loan losses. It's like a bad debt expense that's on the books that helped arrive at the minus 26. I add that back. And the extra depreciation, I take. So I take extra depreciation of the $9,000 on the tax return. So my taxable income for this company that has a $26,000, pre-tax loss on the books, in other words, reported net income is a minus 26, they have taxable income of 40. That would put them in the lower corporate tax bracket, assuming it's a C Corp. That would have been a 15% bracket. So 15% times the 40 gives you income tax of $6,000. That's income taxes payable current. So you'd have to make an entry that says debit, income tax expense current for $6,000, and credit, income taxes payable current for $6,000. That's easy enough, right? But then you got to look at the so-called temporary differences. So let's take a look. You say, well, for the $9,000, which creates a deferred tax liability, I'm getting that interest-free loan in the first year, 9,000 times 15% is the value of the interest-free loan due to Uncle Sam, deferred tax liability, which is $1,350. The other two items create a deferred tax asset. The provision for loan losses, which I take on the books, but I can't take on a tax return yet. Can't take it in 217. And the litigation settlement, same thing. So that's $75,000 times 15%, which gives me $11,250. So that's the gross amount of the deferred tax asset before any valuation allowance. Now you can see I have a valuation allowance of $46.50. I'll have to show you how we got the allowance to arrive at the net realizable value of the deferred tax asset. Okay? Now let's go to the next slide, 71. Right? Now, it's necessary to determine if and how much a valuation allowance is needed. So you should be saying, where did he get the $46.50 valuation allowance? Let me go back one, remember? I'm saying I need $46.50 valuation allowance. So how the heck did we get that? Well, you remember under the old rules, when it came to net operating loss carry backs and carry forwards, you could go back 2 years and forward 20. That's the way it was at the end of 217. Okay? So if you did that, you'd have a little bit of a work paper that looks like this. You'd say, well, here's my taxable income in 217. That's the $40,000. Then if I let the differences between book and tax, in other words, deferred tax items, let them play out, which happened in the carryback years and which are going to happen in the carry forward years. Let's take the depreciation for starters. I know I'm going to get an extra $9,000 depreciation, and then I start paying it back, right? But I get it. In the next 2 years, I'm going to pay it back 2, right? And then thereafter, that's the carryback years. And then the carry forward years, it'll be 2, 2, and 1. So it's 4,000 in the carryback years and 5,000 in the carry forward years. The entire loan loss provision, I'm going to take the deduction on the tax return. I'm sorry. I'm going to take it on the books and then take it on the tax return the next year thereafter. So that would be in 2018 or 2019. Okay? And then the litigation settlement is going to be $60,000. I expense the whole 60 in 17, but I take it on the tax return 1/5, 1/5, 1/5, 1/5, 1/5, right? 5 times. Okay? So that would be what? 12,000 a year. So it would be 12 and 12 is 24,000 in the carryback years, and the balance 12, 12, 12, 36,000 in the carry forward years. So if I let it play out the way the law was, I'd say in the 2 carryback years I'm going to wind up, and assuming I have no future taxable income, right? Remember I had a pre-tax loss, so this company's saying there's nothing we can predict here, we're going to break even. Now, that's important. You might have a different situation, but in this case they're saying we can't predict future taxable income. So given that and letting the temporary differences play out, you'd wind up in the carryback years with a $35,000 loss. And what would you do with it? Well, on a piece of paper, you'd carry it back. So if it was the real life back then, you'd say, let me take the $35,000, carry it back, and get a refund against that $40,000 that I paid taxes on back in 2017. All right, then I still have $5,000 that I can carry forward. But what's going to happen? The items that play out in the carry forward years are going to create a $31,000 taxable loss. And guess what? There's nothing I can do with it. I have no income to offset it against. I'm going to have to eat the $31,000. I'll get no benefit for it. I mean, the $31,000 is a deduction in the future, but I can't deduct it unless I have taxable income. If I have no taxable income, this is useless. So 15% of that is what? Is the valuation allowance. And that's how I got the $46.50. And that's what work papers would look like back before we changed the tax laws. Okay? Now stay with me on this. That's how we got the $46.50. Hope you're with me. Go to your next slide. The valuation allowance is required, again, when it's more likely than not that some or all of the deferred tax asset will not be realized based on the weight of all the evidence. So in this little example here, the evidence indicated that there was no strong past earning histories, there's no presently available tax strategies, there's no ability to change from tax-exempt income to taxable income, and it is likely that the tax benefit of $31,000, the tax losses, will not be realized. We're going to have to eat them. We'll not be able to do anything with them because we won't have any taxable income. Therefore, to the tune of $31,000 times 15%, the tax bracket, we need a valuation allowance. Okay. All right, so let's take this further. If you had a classified balance sheet, you'd say, well, my income tax expense current is easy. That's 15% times the $40,000 or $6,000. The deferred tax is $52.50, and I'm going to show you where that comes from. Look at the next slide, 75. Okay? Actually, I'm going to have to put the 3 slides together. The deferred tax asset of 4050 is the gross amount, less a portion of the valuation allowance, and a non-current deferred tax asset of 72, less a portion of the allowance. Now, you remember the allowance was $46.50. So 1674 plus 2976 is just splitting the $46.50 between current and non-current. I'll show you how we got that in a minute. So where did I get the 4050 and the 7200? Go to your next slide. All right? The 2 larger deferred tax asset items are the $15,000 and $12,000, which is 27 and 15% is 4050. So that's the gross deferred tax asset current. Okay, stay with me. The gross deferred tax asset non-current is the litigation settlement of $48,000 times 15% or $7,200. So those 2, 4050 and the 7,200. Stay with me. This 4050 and that 7,200. They get reduced by the valuation allowance, which is $46.50, but I got to split that into 2 pieces. the first piece is the 27,000 out of the total of 75, right? I got 27 and 48, which is the total debits that create the deferred tax asset. So 27 divided by 75 times the 4650 is 1674. That bring me to a net of 2376. So let me go back. There it is. It's the 2376. It's the 4050 less the portion of the valuation allowance that's current. Gives me the 2376. The non-current portion, 2, would be the remaining 48,000 times 15% is 7,200, and the portion of the valuation allowance would be the 4,650 times 48 over 75, gives me 2,976. That gets us to what? 4,224. So once again, if I go back, here's my 4,224. 7,200 less the portion of the valuation allowance, 4,224. The deferred taxes payable is simply the 9,000 times the 15%. Okay? So I think we're all right on that. And that's the liability. All right, that's the 1,350. Now, that's if you had a classified financial statement. If this was a bank, most banks do not have classified. Some do, very few. But if you have classified, you have to split it into the two pieces. So I hope you're all right on that. So therefore, given all of that, you'd have to make a journal entry that looked like this. I would debit deferred tax assets current for the gross amount of 4,050. Debit deferred tax assets non-current for 7,200. Take the allowance, the 4,650, and split it into the two pieces. 1674, valuation allowance dash current, 1674. Valuation dash non-current, 2976. Set up the deferred tax liability non-current, which is the 1,350, and then plug the difference with an income tax expense credit deferred of 5,250. But I don't like to plug things, so you'd say, well, where do you really get that, Sanchez? Well, that was the 2376, the net amount for tax asset. The 4,224, that's 2376 is the deferred tax asset current. Let's go back. See it? 2376 deferred tax asset current. All right. And the non-current was 2874. All right. I'm sorry. Let me go back. Well, it's 4224. 7,200 plus 2976 is 4224. The non-current deferred tax asset. Minus the deferred tax liability gives me 5,250. Everybody with me there? And that's the journal entry I'd have to make this complete and in accordance with FASB 109. All right? Now, that's fine and dandy. I hope you follow me there. However, in this comprehensive example, we did this for the year 12/31/17. You might recall that the Tax Cut and Jobs Act of 17 eliminated the ability, I don't know if you know this or not, of taxpayers to carry back net operating losses incurred after 12/31/17. Okay? So, in effect, the new law, this is your slide 79, right? Yep, 79. The new law changed the net operating loss carried forward rules as well. Now you cannot go back at all. There's no more carry back. And the carry forward that used to be 20 years is eliminated. Now you can carry forward forever, indefinitely. However, the carry forward amount would be limited to 80% of taxable income. Well, if I change the example we just went over and say, let's make believe we started on 12/31/18, right? So if this comprehensive example for the fiscal year 18, the valuation calculation would change a little bit and we get entirely different numbers. So let's see if we can walk it through. We'd still have the same worksheet that says take the reported net income, which is a loss of $26,000, and say how did we reconcile that to taxable income? Well, we still get to the taxable income of $40,000. Add back the $60 litigation settlement cost, which you cannot deduct yet. Add back the provision for loan losses, $15,000, which you cannot deduct yet, and subtract the extra depreciation that we can deduct right now, okay, on the tax return to get us to $40,000. However, it's times 21%, so the current taxes payable will be $8,400. Here's a little quirk in the so-called tax cuts if you were a small corporation that used to be in the 15% bracket, which means you made taxable income up to $50,000, that puts you in the first bracket. Well, there are no more brackets. There's only one bracket, 21%. So when you used to pay 15%, now you got to pay 21%. So this so-called tax cut really hurts the small corporation. So you can see the income tax payable in this particular case, in this example, if we started in 12/31/18, a company that paid, $6,000 will now have to pay $8,400. So they get a tax increase, all right? But what are you going to do? I don't think it was intended to do that, but that's the way it wound up. So you'd have to make a journal entry that says debit, income tax expense -current for $8,400, and credit, income taxes payable -current for $8,400. Because there's only one bracket, 21%. Then you'd have to account for the so-called temporary differences. Well, we still have the $9,000 depreciation, but now instead of multiplying by 15%, we multiply by 21%. So that would give me a due to Uncle Sam or deferred tax liability of $1,890. We still have the provision and the litigation, which adds up to $75,000. They create deferred tax asset due from Uncle Sam, and multiply that by 21%, and you wind up with what? A deferred tax asset account of $15,750 before considering any valuation allowance. Well, you can see I came up with a valuation allowance. And how did I do that? I got $13,860. Well, let me show you. Go to the next slide. It's still necessary to determine if and how much of a valuation account is needed. We always have to figure that out whenever I have a debit, a deferred tax asset. So the determination is on the following slide. Based on no carryback, if there was an operating loss, and an indefinite carry forward. In other words, based on the new law. Well, if that's the case, here's what we would have done. You still have the $40,000 taxable income, but now we're assuming it's 218. There are no more carryback years, so there's nothing to worry about carrying back. So everything is carried forwardable or carried forward indefinitely. So all of the temporary differences would create $9,000 of income, $15,000 of loss, $60,000 of loss, or 60, 75 minus 9, I think comes out to 66, I'm not sure. Yep, 75 minus 9, 66. Is that right? 66. Well, that's, assuming your arithmetic's good, it's 66. 75. 66, that is correct. But check it out. The 66 is lost. You're never going to reap the benefit. Once again, if you can't assume future taxable income, and that's the most conservative way to go, then the 66,000 you'll lose, okay, until you get some taxable income. So you have to eat the 66,000, this time at 21%, which gives you what? A valuation allowance of $13,860. And that's how we got the valuation allowance. Let me go back. Of $13,860. Everybody with me? Which is very interesting. Reduced the deferred tax asset net to $1,890, which equals the $1,890 deferred tax liability, which is not a surprise. Okay? So, what would happen? The evaluation is still required when it's more likely than not, and in this example, I'm still assuming the evidence says there's no strong past earnings history, there's no tax strategies available, there's no ability to change from tax-exempt to taxable income, and it's likely that the benefit of $66,000 is lost and it will not be realized. Therefore, we need an allowance. And the allowance should be the $66,000 that's lost times 21% or $13,860. Okay. So the current tax expense we saw was 21% times 40,000 or 8,400, not the original 6,000. And the deferred piece is going to be zero, because we had an $1,890 deferred tax asset and an $1,890 deferred tax liability. And how do we get those? Well, let's take a look. We had deferred tax asset of $5,670 and $10,080. I just broke it down into current, non-current. Let me go one slide ahead. The 15 and the 12 gave me 27. 21% of that is $5,670, right? Everybody with me? $5,670. Go back one slide. That's that $5,670. That's the gross. And then I said, what is the non-current piece? Well, let me go forward. 1, 2. The non-current piece was the remainder, $48,000, the settlement cost, litigation settlement, patent infringement, whatever it was, times 21%, which gave me $10,080. And that was Sorry. Excuse me. That was this 10080. Okay? Then I said those two gross amounts have to be reduced by the current portion and the non-current portion of the valuation allowance, which was $13,860. Okay? So, how did I do that? Well, let's do it. I took the $13,860 and I just did a little cost accounting situation here. I said 48 over 75 times the 13,860. Whoops, that's the non-current. Let's do the current first. Yeah. I took the 27, that's 15 and 12 gave me the 27, 27 over the 75, and of course the 75 is the 27 plus the 48, times the 13,860, and it gave me 49.90. And that's how I got the current portion, 49.90, current portion of the valuation allowance. 56.70 less 49.90 gives me 680. Okay? The non-current portion, I took the remaining 48 divided by 75 times the 13,860, and I got 88.70. That's that part of the 13,860 that's attributable to the non-current portion. So if I go back, the non-current portion is the 88.70, which reduces the deferred tax asset to 1210. And I still have the deferred taxes payable of the 1890. All right? That's not going to change. So when the smoke clears, I have to make a journal entry that looks like that. Debit the gross amounts, deferred tax asset current, 3670. Debit gross amount, deferred tax asset non-current, for 10080. Record the valuation allowance, the 13, whatever it was, 860. But record it in two pieces. The current portion of 4990 and the non-current portion of 8870. And then book the deferred tax liability. That's the result of the $9,000 at 21%. And I wind up with nothing income tax expense deferred. And just to prove it, I would take the 680, that's the net amount. Let's go back. The 680 and the 1210 less the 13, less the deferred tax liability. 680 plus the 1210 minus the 1890 gives me 0. Okay? So, it's really the same thinking process, which is what you should learn today. Okay? And that's the deal on FASB 109. It's a very comprehensive example. I hope you stayed with me on both of the situations. Now, I have a little appendix. We don't have that much time left, but I want to go over this appendix and then have some time for questions and answers. Go to the appendix. View full screen. Okay. A couple issues here. These are special situations. All right. The first one is page 2 of the appendix. It's about the reclassification of the stranded tax effects created by the enactment. When they put the income tax, when Trump signed the bill on late December of 2017, the tax rules, GAAP rules, okay, said that if you have to remeasure, and we covered this, I'm going to talk about it again. When you remeasure through earnings, through the income statement. Well, if you did that, everything is fine if what created the issue went through earnings in the first place. But sometimes what created the deferred taxes went through other comprehensive income, like holding gains and losses. Maybe they went into other unavailable for sale securities. They went into other comprehensive income. But the rules, accounting rules, said when you remeasure the windfall, maybe the $6,000 windfall we had came where? Came out of earnings. So if you did that, you'd have these other comprehensive income items that would never go away. They'd be there forever. They'd be stranded forever. So we needed to change the rules. In other words, let me show you some journal entries. Go to a little baby example on your page 4, right? If you had an unrealized holding gain, here, assume we had a corporate income tax rate of 40%, and the newly enacted rate was 20%. So this company went out in 17, before the tax cuts, right? And they bought available for sale securities for $10,000. They marked them to market at 11, all right? So, look at the journal entries. You would have, when you bought them, you would have said debit available sales securities, balance sheet, 10,000, credit cash, 10,000. Then when you marked the market, you would have said debit more available sales securities for 1,000, and other comprehensive income, which is a stockholders' equity balance sheet account, for 1,000. Then you would tax affect that at the 40%, which was in play before the change. So then you would have reduced the OCI by 40% of the 1,000 or 400, and reduced the available sales securities for 400. Okay? Then you'd set up income tax expense deferred for 400 and deferred tax liability for 400 to record the deferred tax and the liability and the deferred income tax expense at low rates. Okay? Then at year end, you'd have to remeasure. In other words, we'd have to reduce the liability by the cut in the taxes. Debit deferred tax liability and credit income tax expense for 200. Well, it seems to me you ought to credit OCI, because that's what created the problem in the first place. We never went through the income statement. But that was a quirk in the accounting rules. So the proposed adjustment early in the year said, instead of this last entry, debit deferred tax liability and credit income tax expense, we should say debit deferred tax liability and credit other accumulated other comprehensive income. And that was the proposed adjustment. And it became finalized. Accounting Standards Update in early 2018 took that proposal and put it into play. Because if that wasn't there, that Accounting Standards Update wasn't there, we'd have these stranded tax effects. They would stay in OCI forever and ever. Amen. Okay? So you might want to look at that example. It worked out pretty good. I put another example in there for you for a holding loss. It's the same thing, except it's the other side of the debits and credits. Same thing. Instead of running the remeasurement through income tax expense, you're now allowed to run it through accumulated other comprehensive income. If indeed it was an accumulated other comprehensive income item that created the deferred taxes in the first place. Okay, so we had this quirk at year end because they passed a tax law in December of 2017. We wound up with an adjustment to continuous earnings, but it was an adjustment of OCI. So we had this really imbalanced. So we put something in that was created through other comprehensive income, but it was fixed through income statement. Okay, and so we would have stranded tax effects. So without that early 2018 Accounting Standards Update that said fix it, you don't have to make the remeasurement through the income statement. You can do what they call back tracing. In other words, you would adjust whatever it was that created the deferred tax in the first place, which in the case for banks and available sales securities, it would have been other comprehensive income. So that's a little quirk, and I hope you are with me on that. The only other thing I want you to cover, and I didn't think I'd get this far, but I will cover it. Go to your page 8 in the appendix. I've got to watch my time here. This is just a little summary of temporary differences and permanent differences. We have some great examples of temporary differences here for you. If you look at your page 8, there are revenues or gains that are taxable after. In other words, they hit the tax return after they're recognized in financial income. And here's some examples. Installment sales accounted for on the accrual basis for financial reporting, but on the installment basis for taxes. Okay? So in other words, I book it, it hits the books first, the income, but then it hits the tax return later. Okay? So there, continue. Well, I'll go back. See that? Page 2 of the appendix? They can see it, I guess. All right. So I went over these journal entries, and given the gap that was in place at the end of the year, you had to make the journal entries that were in that little box that you see on page 4 of this appendix. All right, but that last entry, which was the remeasurement, when in this example, the case, the tax rates went from 40% down to 20%. So we had to remeasure, and the entry was deferred tax liability debit and credit income tax expense, because you had to run it through continuous earnings, even though what created the deferred tax liability were items in other comprehensive income. In other words, holding gains and losses. Okay? So, in the early part of the year, they said, don't make this entry. We came out with an Accounting Standards Update that said, forget about that entry. We're going to change the gap, and make this entry that's outside the box. Debit deferred tax liability and credit whatever created the deferred tax item, which was accumulated other comprehensive income. And that erased this problem that we had with stranded tax effects. Because if we followed the gap that was in existence at the end of 17, we would have never cleaned these things out of other comprehensive income. So we had to change the gap because of the changes on the tax code. Okay, that's all I was trying to say. Then I said, hopefully you can understand that.